Good morning, ladies and gentlemen. Welcome to National Resource Centre, University of Kerala. We are here with a course on financial markets and emerging business models. We have quite a number of reasons on why we have selected this particular course. The title itself is interesting in the sense that it talks about the financial markets and relates the same to the emerging business models. As we all know, finance is the key resources through which we acquire all other resources for any enterprise. And we consistently make sure that we get this finance from the different institutional arrangements which are there in the market. But today, there have been lots and lots of talks on, is finance a limiting factor? There are people who say that if projects are viable and feasible, if the idea is genuine, if the proposition is workable, funds will definitely come. So there's no paucity of funds, there is no scarcity of funds, be it venture capital financing, be it risk financing, be it any other form of financing for that matter, including crowd financing. It is in this perspective that we plan this course on financial markets and emerging business models. I am Professor Gabriel Simon Thattil of the Department of Commerce, University of Kerala. Now this course has been designed with a coverage on financial systems, financial markets, as well as all other propositions relating to banks, capital market, mutual funds, blockchain financing, and the same has been linked to the e-commerce platforms, electronic finance platforms. We look into some of the ethical issues in the financial system that we have, and the concluding part is how we associate this with the upcoming emerging business models which range from startups to multinational corporations. So friends, let us start with the first unit. The first unit is an introductory unit where we focus on what exactly is financial management in terms of the market, how we look at financial system, how we look at the financial markets today, and what are the basic functions of the financial markets and how they actually relate to the economy of our country. I am indeed happy to introduce this because this has been a long-standing learning in commerce, but still at times we are not quite sure whether financial system and financial market has the same segmented broken characteristics which it had long ago. Because 30 years back, we used to talk about financial market having clear-cut segments and funds being insulated, funds being tightened in that segments. For instance, bank doing banking alone, mutual funds and mutual funds alone, debt financing in debt financing alone. But today it is all an age of integration and age of cross-marketing. Now with this objective, we start off with directly looking into what exactly is financial management and how it gets integrated into the financial market. Conventionally, we talk about the objectives of financial management, and there obviously we all come to the conclusion that the two key objectives are profit maximization as well as wealth maximization. But then which is superior and why does it turn to be superior? The reasons are quite obvious. The first and foremost reason is when we talk about profit, it is always considered to be a vague concept. What it actually implies, what it actually means is not always clear. For some, it might be the gross profit. For some others, it might be the net profit. At times, it might be the operating profit. Moreover, profit just signifies the outcome from your economic operations. It just signifies your operating result in financial terms. So, is this just the objective of financial management? can you actually assess and evaluate how your funds have been used only in terms of what output you derived in the form of profits. So here comes the next, the more superior objective of wealth maximization. Now, wealth maximization is in fact maximizing the present value of cash flows that come from your business. It is in fact maximizing the value of shares of your enterprise. Now, when I say maximizing the value of shares, we are trying to talk about maximizing the return to those who have subscribed to the funds of a particular business. Now, this is not just reflection of profits. It is a reflection of many other things. Say for instance, it has got something to do with the market. It has got something to do with the management. It has got something to do with quality control. It has got something to do with the systems in place. It has got something to do with governance. So it's an integrated phenomenon where you look at all these aspects together. So in fact, today, when we are talking about financial management, it essentially focuses on this one concept of maximizing the wealth of the shareholders, maximizing the wealth of the equity holders, and seeing that the value gets reflected in the value of shares. Now, this is not just for one firm. At a very macro level, even the financial health of an economy, of a nation, is often looked into in terms of what happens to the value of shares as is being traded in the capital market. So this has become an integral part of the entire economy itself. So this is exactly the reason why we see turbulence in the capital market and how it gets reflected in terms of events which might not even have any relationship with profits. Say for instance, a company which is making a huge profit, if it has an exit of the CEO or one among the directors, you see a fall in the market price of shares, which is again an issue over which you have to look at ways and means of maximizing or getting your wealth corrected. So everything that we do in finance, starting from sourcing funds, using funds, application of funds, your investment, your dividend, your liquidity, ultimately is going to be based on how it impacts wealth. Now, this makes something very clear all throughout when we look at the financial market, when we look at the support of the financial market for business models. Each firm tries to see or tries to examine the robustness of the capital market or the financial market in terms of its services in ensuring good governance and good systems that will keep your stakeholders happy with the activities of your organization, and there it stands to be supreme and superior. It's not just you're getting profits. Definitely profit is important, but wealth maximization includes profit as well and makes it a superior objective for business to achieve. Now we need to look at what are the approaches to finance. Here we see a traditional approach, a medieval approach, and a modern approach. Towards the beginning, we were trying to look at this particular course, linking financial markets to emerging business models. The typical reason for this is the fact that what exactly is the approach that we adopt towards finance. Conventionally, we believed that the role of finance was to just raise funds. A finance manager was a person who was supposed to raise funds when a project comes before him. You need to construct a building, you ask the finance manager to find funds for that. You need to construct a dam, you need to procure machinery. When a project is at hand, you place a proposal or you place a request to the finance manager, and the only function of finance was believed to be raising money at the right point. This was traditionally what we believed finance to be. But in a medieval approach, we said it was not just sufficient that you raise money. Equally important was the fact of how we use the money that we have raised. So the medieval approach to finance was raising and using with an equitable kind of weightage to both. So you raise money and it again became the responsibility of the finance function or the finance manager in charge to see how this money was utilized. Now the modern approach. Modern approach typically says you need not give much importance to raising. And that is why we are saying what is important today is using or just simply the wise application of funds. So we are trying to believe that, because it's quite clear that without raising you cannot use. But we have come to understand that raising funds is based on the viability of a good proposal that you have, the proposition that stands before you. If you have a wonderful idea, if you have a beautiful workable business proposal with you, funds will just flow in. And the objective here, or the main task of the finance manager, is to see that you work this out, you apply your funds, you use the funds in such a way that the amount that has been given to you, the finance that has been released to you, has been wisely applied, which stands as a justifiable proposal to ask for more. So if I have been entrusted 10 lakhs for a proposal or a project and I work it out well, then I say that what has been given to me has been well utilized and I ask for more. So essentially today, if you, those people who have beautiful workable ideas, which are transformative in nature, which are scalable in nature, which are developing in nature, then finance is not at all a constraint for them. Funds will come in, there will be people to finance their proposals, and what is important is to see that you apply it in the right form. So the skill, the talent of finance and the challenge of finance today is wise application. And this particular course under Arpit, which we are putting in the NRC, talks about this wise application. And when you have this wise application in that form, our financial market is so integrated with so many innovative products, with so much of financial services to support. The idea is you keep your ears and eyes open to the various sources. You keep tapping on each source and see that the funds are utilized well, and then you grow up into new scalable heights. So we are talking about an approach, a shift in approach, which conventionally believed in raising money, then shifted to raising and using money, and today it is basically resting on a philosophy of wise application of funds. Now we need to understand the scope of financial management. The scope of financial management, or the coverage of, as we all know, of financial management, is based on 4 typical decisions. Number 1 being the investment decision. The second is the financing decision. Third, obviously, is the dividend decision. And finally, the liquidity decision. Now, this is very sequential. We clearly understand this as sequential in the sense that in the first decision, you take a decision where how to commit your long-term funds. Now, if you have a viable proposal, you establish the viability of that proposal, you do your financials on that particular proposal, and you decide whether you need to invest or not. The decision to invest or not is based on what surplus you create out of it, what economic value addition comes out of it, what profitability it has, and how it supports the wealth maximization objective of your firm. So in the first place, you decide whether to invest or not in a particular project, whether to commit funds or not into a particular project. Your answer here could be yes or no. If the answer is no, this project is not viable, this project is not worth supporting, this project is not justifiable in terms of its feasibility, then the subsequent decisions will not come. Contrary to that, if your decision is yes, this is a proposal worth pursuing, this is a proposal where we can go ahead, then comes the next decision, how do you finance it? Now here again, the sources are too many. The funds that you get can come from a number of sources. It can be global, it can be national, it can be regional, it can be from different segments in the market. It could be through debt, it could be through equity, it could be through institutional finance. Institutional finance, again, it could be through concepts of angel financing, crowd financing, it could be through venture capital. There are numerous ways through which you can source the funds. Now again, if you have taken a particular decision as to go for a particular source, then comes the next question, how do you service it? If you have raised money through debt, you have to look at issues relating to payment of interest. If you have raised money through equity, you will have to pay dividend. If you have raised money through institutional finance, you again have to pay interest for what you have raised. Now, each of this source and its servicing has numerous implications. Say for instance, if you are raising money through equity, you will have to meet the expectations of the stakeholders or the shareholders who have given you the money, and you will have to keep that expectation at par with what is there in the market. So again, you have to also look at tax considerations, you will have to look at regulations in the market, you will have to look at considerations on capital structure, governance, so on and so forth. So whichever source you choose, it has got implications which are not just finance, it will have very severe financial implications at the base, but there are lots and lots of other implications which adds on to that. And finally, we have to go into your day-to-day working capital requirements, which come under the category of liquidity decisions, with which we look at how you manage funds for your daily use. It starts from cash, moves into different operations, and again comes down to cash. The pace with which you convert, the ease with which you convert, the rapidness with which you can transform talks about the good liquidity decisions that you have. So financial management talks basically about where to invest, how to raise money, how to service the source, and how to have your daily operations supported in a manner in which it justifies your organizational as well as the market needs. Now here again, when you decide to finance with each different source, implications, as I said, are different for the different sources that you have, be it debt, be it equity, be it institutional finance. But here again, we have a potential to borrow from abroad as well, which comes in the form of maybe external commercial borrowings or even American depository receipts or global depository receipts. Now at this point, let us understand something. A typical example of a very small petty shop running by the wayside to a multinational corporation. Both these are enterprises. When we talk of an MSME, when we talk of a startup, when we talk of a unit in the unorganized sector, to a very well-developed multinational corporation, they all need funds. They all have requirements for funds on a long-term basis to finance their operations, to finance the procurement of the fixed, the permanent assets, and to finance their daily operational needs. In short, they need funds in the form of long-term capital, and they need funds in the form of working capital. Now, when you look at these organizations, certain things that we can understand is, the more organized you are, the more scalable you are, the more regulated you are, the more you get into the intricacies of meeting legal requirements, the options that you have to source funds will be large. This is why I made a comparison between a very small micro unit, which is in an unorganized sector, which is perhaps a petty shop on the wayside. They do not comply with many of the regulations in terms of registration. They might not have your KYC under them obliged. So what happens? The access that they have to a wider global market gets restricted. Contrary to this, if I am an organization which is registered, which complies with statutory requirements, which meets global standards in all its operations, then I have access to all possible sources of funds. It may be from the Indian market, it may be from the global market. So what we have to directly imply from this is the extent to which you get organized, the extent to which you get regulated, the extent to which you comply with standards, the options that you have to move into a market is very large, and you can source money from different places. This is typically again the reason why we are linking markets to emerging business models, which means if I know of a global opportunity that exists somewhere, I translate this into an enterprise to take advantage of that opportunity. I can see funds flowing from different sources, from different segments in the financial market, which need not essentially be internal. It can be from any other part of the world where the cost of capital is low, or perhaps the issues in sourcing is relatively less complex. I can do all those things on that matter. So that is where we try to look at the financing decisions, the sources that exist to finance an opportunity which is very ripe, which is very sharp, which is very focused, and which has got a long life as far as scalability is concerned. So we need to evaluate the different sources that we have in terms of certain parameters, and these parameters are highly generic, but they have something in common. So normally we look at each source in terms of what is the cost of funds. If I say debt, I can source debt for a particular period at a given rate of interest which is decided in advance. If I source equity, there is no pre-declared rate at which I am going to service it. And this is going to get reflected in terms of what is the expectation of the shareholder from time to time. This year the shareholder might expect 10%, next year his expectation might go to 20 or 25, and that expectation again is based on how the markets are doing. So here, if I am going to raise money through equity, I need to look at what is the expectation of those who are going to be my stakeholders or my shareholders from time to time. And these shareholders have an expectation which is always associated with the market conditions. If you meet their expectations, they continue to hold your shares because shares are easily transferable. If you don't meet their expectations, there is a chance of their selling your shares, in which case the market value of your firm will again fall, and this will be against your expectation on wealth maximization. So the cost of funds is very, very crucial. Perhaps the cheapest source could be institutional finance or even the debt instruments. But how much of it can be accommodated is again based on regulations, because you will have to meet your capital structure considerations, you will have to meet your capitalization norms, which is fixed maybe for some industry at times, or fixed by and large in terms of governance under the regulatory framework that we have. So cost of funds is so crucial on that matter. Along with that, we need to look at risk. Say for instance, if I serve my fund requirement by debt, I have a permanent commitment to give out the money at a particular rate. So it has a level of risk which we need to conceive in advance. It has to be paid irrespective of what is the return of your enterprise. You might be running at a loss which is crores and crores together, but you will have to meet this if it is debt. If it is equity, perhaps you can keep the payment at a lower level or a different level for a time being, but even at the long run it has to have a reflection with the expectation of the shareholders. So the risk levels of different institutions, different segments in the market do vary. Similarly, you have to look at your other considerations in the raising cost. Say for instance, if you need to raise money through equity, you will have to have underwriters, you will have to have lead managers, you will have to have issue managers, you will have to have a host of services supporting it, and all these requires payment. So it is the raising cost for equity is relatively large. If you are going to have raise the money through an institutional arrangement, it's a one-to-one kind of negotiation, and the raising is between the two entities. So raising cost is going to be relatively less. Similarly, there are tax considerations also. The tax considerations, if I raise debt, the interest that I pay is tax deductible. But if I am raising money through equity, it is not tax deductible because it's an appropriation that happens from the profit. So these considerations still prevail over there. Again, the market conditions is very important. If you look at a time period when the market is very volatile, the market is experiencing severe turbulence, then under those conditions, we have to be very, very careful in entering the market. And this is quite evident when you look at the number of IPOs that have come in the Indian capital market immediately after the subprime crisis or immediately after the Southeast Asian crisis. You see it significantly coming down because market conditions are not robust, market conditions are not proactive in terms of taking advantage of a new issue. Market conditions are so crucial on how you can look at a sourcing avenue that you have. So this is why typically the health of the financial system contributes to entities in their raising process. Similar is the capital structure conditions. Capital structure talks about the combination of or the ratio between debt and equity. Now, if your capital structure is currently overburdened with debt, the potential that you have to raise further debt is limited because of several reasons, of which one reason, as I said, is the regulatory framework which prevents excessive capitalization, the risk that is going to be there in your financing mix that you have, and again, your capitalization needs not being met. So what is the current capital structure is also a factor which needs to be considered when you look at your proposition on how to raise money. Again, another crucial factor is what is the nature of the project. If it is a project which has a long gestation period, if it is a project which is going to give back its return only after a long term, then the financing of that should be done accordingly because you are expecting inflows to happen only over a long period of time. So these host of factors require consideration in terms of deciding which is the appropriate form of your sourcing, and you relate that to the financial market that is there for you in your economy. But in a globalized environment, we find a strong integration taking place, and it is that integration that makes us look at the look at the financial market very closely. The financial market has to be viewed very closely in this context. Now, if you look at this particular chart, we are just trying to look at how each of these perspectives have a different implication on debt, on equity, on institutional finance. Say for instance, suppose you look at cost of funds, debt might be low, equity is high. As far as institutional finance is concerned, it is very low. So the cheapest perhaps will be institutional finance, but how much of it can you procure? The larger the size of your project, the amount that you get through or procure through institutional finance will be less. Say for example, a small micro enterprise which requires funds maybe 20 lakhs or 10 lakhs for a project might get maybe 50% of its financial requirements through institutional finance. But if the same project is being run by a multinational corporation, it needs 50,000 crores, perhaps what it can procure from institutions gets limited. So here we have a difference. Although we say institutional finance is very cheap, the amount that you can source and the access that you have to it is at times limited. So we cannot just look at the cost implications alone. We need to relate it to the supplier of funds as well. Similarly, when you look at risk, the risk for debt is high, as we saw earlier, because it has to be continuously and consistently serviced at the predetermined rates. Risk as far as equity is low But we cannot always say that you have a discretion to postpone payment, because it has a direct reflection on what we earlier discussed in terms of wealth maximization. If I decide not to pay for 1 year, 2 year, 3 year, how will my equity shareholders look at it? Will they compare this with other firms in the industry? And is there a possibility that they sell my shares because other shares are doing better? In that case, the market value of the share will fall. Your wealth maximization objective will get totally jeopardized. So here we have risk low, but this impact coming out over there. We have a high risk again for institutional finance, because at the prescribed rate you need to serve it. Again, when you are looking at the raising cost, again we saw that raising cost is likely to be high for equity. It can be very high for equity, relatively low for the other sources. Similarly, tax considerations that you have, we saw the deductibility that exists. So other factors have just been put in terms of a comparative chart, where we need to have an assessment, where we need to have a mapping on how these factors will have its impact on my organization, how it will have an impact on the project which I am financing, and how it will react to the business environment in which we typically operate. Now, with this in the backdrop, or with this context that we look into, let us try and look at the financial system.